Chapter. We're talking real money.
All right, I just want to start the show today talking real money. That's the name of it, by the way. But first, I want to talk real laundry. Thank you so much. Did you throw that towel away?
That is an awful looking towel.
Did you throw that towel away?
It's on the ground. I don't know what to do with it.
No. Why is that towel not in the trash?
I don't know where that came from.
That is the nastiest looking towel I have ever seen anywhere. And it was in the laundry room.
You should have seen the sympathy I got from the cable guys who came in today and said, wait, you do the show from in here? Yeah, we'll find you a way to get the cable.
We're going to get you cable to the
We'll make it
office.
happen, dude. Yeah. Anyway.
Hey, everybody. Welcome to Talking Real Money. I'm Don McDonald along with Tom Cock, and our phone number is 855-935-8255. Should you have questions or commentary about monetary issues of any kind. Before we get the actual fun part of the show started, we have to begin with a correction.
Isn't this what they say in the printing business? Don't they say we regret? It's something like that. They put that in there.
I don't know.
All right.
Who reads printed material anymore?
I feel badly because the person who called us was so happy when we gave him the news, and now we have to retract the news we gave him. So I'm only laughing as a defense mechanism because I feel bad about this.
Yeah, it's not funny, but he's nervous.
James wrote us from Cincinnati, Ohio, in relation to a call that we got last Saturday about an RMD, required minimum distribution. Now, the caller had an IRA, but also still had money in his Boeing 401k. So it's a little confusing. It's like, well, do I have to take it from both? Can I take it from one, et cetera? And we told him.
Now, you're talking about with a backdoor Roth.
No, this is just withdrawals from those accounts.
Just regular withdrawals.
That's right. Required minimum distribution. We told him that you can just add up the whole total and take it from any of those accounts, because that is true when it comes to individual retirement accounts. But when you start dealing with ERISA plans like 401ks, 403bs, and he actually sent me the write-up from the IRS.gov website, RMDs are required from other types of retirement plans, such as 401k, 457 plans, must be taken separately from each one of those plan accounts. Pardon me. So you have to.
I'm looking right at it.
We just got it wrong, because here's the reason why, and this is not a good excuse, but it's the only one I got, is when we look at this, generally people have already moved money from their ERISA type employer sponsored plan to an IRA. They may have several IRAs. Mm-hmm. That's okay. And you can just draw it from one as long as you've figured out the total that's due. So I'm really feeling bad about giving the bad advice last week. I hope the gentleman's listening again. So anyway, that's the reality.
There's a lot of stuff. There are, and it's funny. There are so many particulars and caveats and, as you said, codicils to the almost anything you do. It's hard to get it all right. But, when you have a 401, you got to take it out of there, too. Now, let's pull the curtain back here a little bit on the financial services industry, particularly the brokerage firms out there. We're talking about the places where your money is custodianed. Firms like Merrill Lynch, J.P. Morgan Chase,
mm-hmm.
Wells Fargo recently got into trouble. These firms generally they all have what is called a sweep account. This is the account.
It has nothing to do with keeping things clean. Yeah, it's
just making sure your money gets swept into something that makes money after you make a sale of a security in a custodial account.
I hope you're using air quotes when you say make money, too, by the way.
Yeah, because what these firms have discovered is that making money, if you give away all your trading, you don't charge commissions on stocks or ETFs, you have to find another way to make a profit. And they found a very profitable way to do that by sweeping your money into an account that earns less than 1% a year. In many cases, way less than 1% per year.
The article said that Bank of America / Merrill was paying nothing until the SEC came along and said, we're looking into this. And all of a sudden, they jumped it up to 4%. We better fix this right away.
Oh, they went to 4%, not 0.4%? They went to 4%.
Yep.
Yeah, because Charles Schwab, whom we like, they've been gradually lowering the rate they pay, even though rates have been slightly rising. We want to talk more about why this is necessary and what you should do after this.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
You've heard of invisible ink? That traffic report was done with invisible words. Just you weren't listening closely enough. Yeah, just visualize.
Oh, I see.
Anyway, welcome back to the Talking Real Money program. I'm Don McDonald. Thank you so much for being there, along with Tom Cock. And we're talking about the problem of low interest rates, particularly at brokerage accounts, whether they're discount brokerage or full service brokerage. The problem is, the issue is pretty much universal. And the SEC is starting to fine companies. They filed suit against a number of them, including Charles Schwab.
Yep.
And they're saying that they are violating their fiduciary responsibility by putting the money into, not necessarily even putting the money into the lower yielding accounts, but by not, I think they're saying they're not making it clear that there are other options.
Thank you. That's the bottom line here. And the fact is, you as the consumer, sadly, you have to know. Because if you just let them do whatever they're going to do, guess what? You're right. They'll go in that sweep account instead of, you could still make a decent amount in a money market fund. You could make money in, some sort of short-term bond, things like that are paying at least something instead of these sweep accounts. Where, as you said, Don, they will continue. And by the way, they raised the rates up. And then the minute the Fed cut those short-term rates, they started knocking those sweep accounts right back down quickly because they're going to be well ahead of that.
And to let you know what the difference is, and I want to use Charles Schwab. Merrill has already gotten a big fine. Wells Fargo got a big fine. Morgan Stanley's looking at one. But Schwab is a company that we suggest to a lot of you, and we're not happy they don't pay much. Please understand, we are not thrilled. We understand it because they're saying we got to make some money somewhere. If we don't make it here, we're going to have to find another place. But the Schwab sweep account pays right at 0.5%.
Half a percent.
Half of a percent.
Yeah.
The Schwab money market fund,
I think it's still paying somewhere in the fours.
It's in the fours, but I just want to get it.
But this is the kind of thing you need to pay attention to if your money's at any of these major brokerages.
Yeah, as of right now, it's at 4.19.
Yeah, okay.
So, for example, I had done some rebalancing, and I moved the money moved into my sweep account, and I didn't think about it for a week or two, where it sat there earning nothing, and then I moved it to the Schwab money market account until I decided where I'm going to put that money.
And let's give you a little perspective about why these brokers are doing it. And remember, for many years, they made the money on trading. I mean, back in the day, they've charged huge amount. And then Schwab's the one who came along and changed discounted it, all that.
Right,
because
they didn't do it for free.
No, they didn't do it for free. And now you can trade those wonderful exchange traded funds for nothing. So they do not make money there. There's less and less of the sort of backroom revenue sharing that there used to be in the business as well. So these firms are looking around going, okay, where are we going to make a profit here? As you said, Don, and this is an easy place because here's the problem. People generally with this kind of loose change, if you will, they're not very efficient with it. It kind of sits there we see this in people's savings accounts at major banks, checking accounts where they're making nothing. So it's really down to you to be really efficient and to know, as you said, the options. What could you put this in? And then insist on it being moved to that when it's available, rather than having it just sit there in one of those sweep accounts.
Yeah, and just to show you how there's a lot of money involved. Schwab says that this could be tens of millions of dollars in their pocket because there are hundreds of billions of dollars in these accounts. And it's really interesting. If you look at just the last 6 months, Schwab has cut the rate on their sweep account. No, interest rates have remained relatively steady.
Not moved around a lot.
They cut their rate from 0.45, just a little under 0.5%, to 0.05. Half of 1%.
Yeah. And that's just, this is as I said, they're always way out in front on the cuts, not so much on the raising of that. So yeah, these sweep accounts, they're going to get more scrutiny, but unless you're paying attention, yeah, you're going to pay a price.
So what you need to do is when you make a transaction, if your advisor should do this for you, but if they don't, and if you don't have one,
I'd pay attention.
Even then, when the money goes into that sweep account, make sure somebody is moving it from there into either another security or your money market if it's a parking place for a while.
Yeah, if it's not money that's going to be invested in some way and it's short-term cash.
Go into the short-term cash, go into the money market, make 4 instead of like 0.04.
Yeah, it's ridiculous.
Isn't that about, if it was 0.04, that would be 100 times more.
I think it's 10 times more, but who's saying
no, because wouldn't it be 0.4? Because 10 times more would be, no, you're right.
I think it's 10 times.
I meant 0.04. 0.04.
Okay.
0.04, which is what a lot of these firms are paying.
Yeah.
To 0.4 would be 10. To 4.0 would be 100.
Right.
That's a lot more money.
Do that with a gallon of gas and repeat if necessary to see how big deal that is.
And speaking of fines, another company that we talk about a lot, there's a lot of fining going on these days. Vanguard got hit with a big
$100 million.
A big fine.
Yeah, $100 million. Now this.
And what was that for?
Well, remember, this goes back to when the target date retirement funds. Remember where they allowed people to move from into the institutional version. So a lot of people took their money and said, "Sure, I'll move it over to that because it's cheaper."
Mm-hmm.
And they left all the people still in there that they had to sell securities for, right? Because all the cash had moved. And people paid huge capital gains tax bills if they were not in IRAs. Big.
Yeah. And let me kind of help you wrap your head around that. When you lose just the normal number of participants that they anticipate, the funds generally have cash for that. They don't have to go in and sell shares, because when you sell shares at a gain, there's a capital gain that must be passed along to shareholders. Generally, they're very small. They've been very small historically. But when they had a wholesale sale of their regular fund, with people moving into the target date institutional fund, they were forced to sell securities often at huge profits. And the only ones who got stuck paying that, were those of you who were in the fund after the institution or the larger investors left.
Yeah, and $106 million will be distributed to harmed investors. Vanguard said they're very sorry. They won't do this again. But here's another recommendation, by the way, for a target date fund. I do not think they're a good place for non-qualified. Unless it's an IRA, I would not use a target date fund.
Not a target date fund. A target date ETF, maybe.
Maybe.
But not a target date fund, because two things. One, a target date fund is on a glide path, so it's going to have bonds in it. Even the far out ones still have a few bonds in them, which means you've got an income stream that's taxable.
That's right.
Then two, there will be transactions within as people buy and sell, so you'll have realized capital gains that are going to be distributed, even if they're not to the extent they were with the target date debacle at Vanguard. You're still going to have those, and you want those to be either deferred or tax free. You don't want to have to pay taxes on them until you absolutely have to.
And now I was always, when you said target date ETFs, I want to make sure there are those, because didn't we look into this once and we couldn't find any or something?
So, I think I found one recently.
Okay, yeah, I see them here are at iShares, et cetera. So
iShares,
there are
that was it. iShares have them, yeah.
Okay, so there are target date, again, which we think are a great solution for many people that don't want to deal with their portfolios, just want to set it and forget it. That's a good place for money, sure.
And the nice thing about the target date ETFs is that they do not have to distribute capital gains because of the way ETFs are structured most of the time. Can there be exceptions? Of course. Remember, there can always be exceptions. 855-935-TALK.
Tom and Don are talking real money. For For your real life and real future, Tom and Don are talking real money.
Welcome back to the program. I'm Don McDonald. Tom Cock over there. Yes, what are you chuckling
anything
about
nice
there,
to say
Thomas?
about anybody in the business before we get the boot?
Never do.
Okay. All right.
Try not to. Again, it's not that we dislike what they're doing at Schwab, or they have to do it for a reason. But in a perfect world, I would prefer that they tell you.
I agree.
That they say that they send you a note saying, "Yeah, your money's here." If you
never going to happen.
Yeah, no, it won't happen because they don't want to give up money.
Nope.
855-935-TALK. Please give us a call if you have a question about money, things of any kind, saving, investing, spending money, insurance, working for a living, retiring, all of that stuff. 855-935-8255. And now we head to Paulsbo. Dan, welcome to the show.
Hey, can you?
Uh-oh. We have a bad cell. Try it again.
I'm here.
Okay.
Hurry.
Hopefully we can hear you through the dropouts. What's up?
Anything? Can you hear me now?
Yeah.
I can hear you. Yep.
Okay, good. This is routinely a problem when I call you. All right. But I think this may tie into your talk about sweep accounts.
Yeah.
And this has to deal with Fidelity. I have a former employer 401k that I've just left in Fidelity. I haven't funded anything at Fidelity. It just sits there. At the start of the year, they said, "Hey, why don't you try this where you put in $1 a week, increasing by $1 every week for a year."
The 52-week money challenge.
That's better than the ice thing challenge. I think I'd like that better than that one. Yeah, that would it's cold.
Right.
Yeah.
Well, now the way you're talking, because I was thinking about last night, I've got $3 in there now. It's going to be
doing it for 2 weeks.
I can really do anything with that money.
You've been doing it for 2 weeks, but here's the deal. The way this works is you add the amount.
Increase the amount.
You increase it, but you increase it by the number of the week. So week 3, by the end of week 3, you're going to double your money.
Yeah, and
you're going to have $6 whole dollars.
If you put it in IBIT, you could be back to where you started again. So,
stop it! But by week 52,
year, I think it's like $1,350.
Yeah, it's almost $1,400 at the end of the year.
Right, but
it's just a forced savings
there's really
thing.
Enough money that I can purchase with it.
Actually, if you carry that out, if you make it more than a 52-week challenge, you make it like a 520-week challenge. By week 520, you're putting in $520
a week.
Pretty soon, we are talking real money.
So what he's asking those, what can he buy with the small amounts?
It'll be out of the budget.
Yeah, you're asking about what you can purchase with that small in there?
Don't purchase anything.
No. My point was, after hearing you talk about how some of the companies weren't adequately paying people for the money just sitting there.
Got it.
So I feel like this money is going to be sitting there, not used for quite a while before it's like enough to purchase anything with.
Well, can he move it into their money market?
I would imagine
that's probably what we could get to the point of here. I was just thinking, and I don't know what it's earning now, is this Fidelity's way of just getting cash into their system that they can invest, like you were talking about the other companies doing.
Actually, they're not a lot of companies have been pushing this 52-week challenge. I've seen it at other websites and other banks and credit unions and things like that. It's not going to do a whole lot for their bottom line. It's more of a way to encourage saving and to just find a way to make it a little bit more fun and to make it feel more rewarding. It's a psycho game. It's a psychological game they're playing because they're saying put in $1 week 1 and you'll have $1,378 at the end of the year.
Yes. In that respect, I thought it was really cool. I want to recommend it to my 21-year-old since now I'm looking at it a little bit. It'd be great for a young investor.
Yep. It would be awesome and plus what it does is it creates a habit. And what you find out, the other thing that they're thinking about is that you are like, by the time you get to the end of the year, you're starting to get accustomed to taking a decent amount of money out of your paycheck and not spending it.
Well, and he can go right into the money market. at a buck.
And you
a
can
share,
go
right?
into the
Right.
money market or a high yield savings account. You could do that with any high yield savings account. If that doesn't have a minimum, you just start with the buck, go to the 2, go to the 3, go to the 4, go to the 5, and I think it could be long term great.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Hello again, and welcome back to the show. I'm Don McDonald with Tom Cock. We just do this all the time. We hang out talking real money, and we hope you will join us at 855-935-8255. It's free. It's easy. We'd love to talk with you. 855-935-TALK. You can also, though, send your questions in at talkingrealmoney.com. And Tom's got one of those, I think.
I got a lot. I mean, it's been busy.
A lot.
I got a lot. So,
wait.
yeah.
Hold on. Before you get to the question.
Sure.
It came through. Woohoo! If you do the 52-week challenge,
yes,
but you do it for 520 weeks. So by the 520th week, you're putting $520 a week away.
Yes,
it's a little over $2,000 a month.
It is.
Which, in 10 years from now, maybe you can afford that. Maybe. At the end of that time, with no money being made on that money.
Just putting the money in.
Just putting it away. You will have put away $135,000.
In 10 years.
In 10 years.
Okay. Hey, nothing wrong with that.
Seriously.
That's a lot of work. That's a lot of record. Okay, next week it's 2. That's a lot. Sounds like a lot of work to me. But no, I love the saving thing because we know we run into people all the time that want to talk about their portfolio, but they forgot the first part about having money to build a portfolio. So, you got to save something first. And we need to start, you're right, with young people, as he was saying with his 21-year-old. Figure out how to set aside.
Basically
15,
it's just teaching you how to
food.
save.
Yeah,
I mean,
exactly.
That's the whole point it's just, and like everything we talk about, it's about making it a disciplined process.
Mm-hmm.
Anyway.
I tell you that, I mean, you know this, the way I've always saved the most is with the 401ks, et cetera, because that just comes out of the check, goes right in. Never see it. Can't spend it.
Right.
Yeah. It's easy. All right. Questions? Okay. Question. Chuck from Boise, Idaho. I see a lot of callable CDs on the Vanguard site. Mm-hmm. I've stayed away from them, but I wonder how often these are called and if there's a way to see the trend in how much difference there is to triggers a call. I know you and most advisors seem to discourage and don't take a chance with them. Thanks for all you do. Callable CDs.
Callable CDs basically give you the worst of both worlds.
Easy answer.
Yeah, what you get is you get a yield that's close to the current market yield, often just a little tiny bit higher.
Mm-hmm.
But what you're trading in is the ability, and this is why I don't like them for ladders, the ability to lock that yield in. Because it won't take, and I don't know statistically what the norm is, because I would guess it changes based on market expectations.
Sure.
But a bank can call that CD when rates go down, and they can issue new CDs at lower rates. So I can't imagine it would take very much, maybe a 0.5% reduction. I don't know. But I don't like to take the chance of losing my ladder, because the ladder is supposed to be the discipline. The ladder creates the discipline.
How about callable bonds?
I don't like callable anything because, again, the whole point is to try to eliminate some of that uncertainty that exists in your stock portfolio, because there's such a high degree of uncertainty in your equities. The bond portion of your portfolio should not be owned. And this is where we are our own worst enemies. Is we want the bonds, but we don't want just the average rate. We want the highest rate. We want to make the most. No, you shouldn't be looking at bonds that way. You should be looking at bonds for the best stability. And non-callable are going to provide better all-weather stability.
And I feel like people make a lot of mistakes around that, and they get sold a lot of things. thinking they're getting a great deal, as you said, because the rate looks higher. They don't realize that that rate may only be there for a year or two, and that the person that sold them that bond took a pretty hefty cut. And this is why I really like bond funds rather than bonds. So,
yeah.
All right. Want another one?
No, I don't want another one.
Okay.
By the way, I tried to do this calculation
He's good
by
at that,
adding
by the way.
5% annual interest to it.
To the $1,
dollar
$2,
first week,
$3, yeah.
$2 second week.
Over 10 years.
Over 10 years, $160,000.
Wow, 5%. That should be doable.
Yeah, that should be doable. I mean, it's not making you rich, but it's only 10 years from now. So if you started this when you're in your 20s, by the time you're in your 30s, you have this nice, safe 5% nest egg. Not bad.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Hey there. Welcome back to the show. It's sort of a strange one today. Been thinking about things like, we're coming up on the big game, which really is called the Super Bowl.
Yeah,
it's really
we're going to start calling retirement the big day instead of retire me.
No, but it always bothered me that in commercials and things they say the big game.
Yeah,
they're afraid to say Super Bowl, but they think it's because the NFL trademarked the term Super Bowl, but the reality is Kimberly Clark trademarked the name Kleenex, but I can say Kleenex.
Yeah.
Hand me a Kleenex.
No one wants to mess with the $19 billion a year NFL.
And that's all it is because
don't get in the way.
Legally, I'm no lawyer, but I know the term nominative use. If you don't imply an endorsement by the NFL or the Super Bowl,
you're okay.
You can say the word the words Super Bowl.
You've been around the compliance people, so you know what they're looking at that.
I know. Everybody's like, but they've got more lawyers than I have.
Way more, yeah.
Hey, I took on McDonald's. I don't fear anyone. I did. They tried to make me stop using McMoney.
I remember that.
Back in the day, back in the early...
It's not as tasty as a McMuffin either, by the way.
I'm so stupid. Because back in the mid-90s...
1990s.
I picked up all kinds of domain names and just let them expire if I didn't find a use for them. Today, I could... Oh, my gosh. Somebody... Oh, it was Michael Saylor of MicroStrategies.
Yeah.
MicroStrategy. Way back in the 90s, he bought the domain name voice.com. Made $30 million.
Just by owning that.
By selling it.
Yeah. And, of course, now he's sitting around buying Bitcoin every day, so he didn't have time for websites.
With borrowed money. Oh, that's a topic.
We'll see.
We're going to do that one.
Yeah.
Mm-hmm. 855-935-TALK. Give us a call. We're talking about your money and life, too. And let's go to Tom's favorite place in the state of Washington, Spokane. Martin, welcome to Talking Real Money.
Hi, kids. My question is, we just received just a touch under $350,000. My father-in-law passed away, but he was 102 and a half. So, and to Tom, he was of that great generation, and he flew B-25s in the South Pacific, and got a couple of oak clusters for that. And I think Tom would understand what skip bombing was.
Yeah.
And that's what he did.
Wow.
Anyhow, the money still was some left after 102 and a half. So we have about 3.5, and I'm with Charles Schwab a little bit. My an investor, my guy, has got us in that, but I want you gentlemen to tell me which fund I should be in. Now, we're both 65. My lovely wife will be 66 in February. We do have money with him. He talked me into an annuity a couple of years ago, and I will. I know. And you guys had warned me, and he was a slick talker.
Why is he still your guy, Martin? Why is he still your guy?
That's what I'm in the point of. I think we've been with him for 4 years, 5 years. He made me a lot of money in the beginning.
No. Then, he didn't make you any money, by the way. The market made you. This is something people tell me all the time. You made me a lot of money. No.
Yeah.
You built the right portfolio.
Well,
I didn't make you that money. He didn't make you that money either.
Right. Well, he's got my mom who's going to be 90. He's doing well with her, as far as I know. With me, you guys have to realize I'm not as active as I was on the computer because I had an accident and hands don't work, legs don't work, so I can't just jump on.
However, though, Martin, let me just interrupt because of this. I'm sorry, because of limited time, but the reality is your brain works and you at our age, and you called us kids. You're the kid.
Yeah.
We're older than you are. This is why this is the time to have a true fiduciary advisor in life anyway, who's going to use their hands and feet to make you a portfolio that is not based on the best thing to be in at a particular time, which my guess is what your current advisor does. Oh, I know where to be at what time, and if I do this right, I'm going to make you more money. We don't claim to make anybody more money at all. We don't claim that. We claim to build portfolios that are right for you. And that's what you need to find, is a true 100% fiduciary advisor who is going to do what is right for you, but not based on a quick call or a hunch. For example, asking us where you should put $350,000. If you've listened to us for a while, you know that's a question we can't answer because we don't know you.
Yeah, I know. Well, I was a 50-50. He's got me in high risk in some stuff. Now I want to balance it out from that. So I was hoping to get from you guys, kids, what you would recommend in Charles Schwab for something that was low risk. Because
hold on. Hold on. This is not the way it works.
Yeah.
Here's the problem. Okay, let me take a giant step backward. This might help. Do you know the names of the products you are in right now? The high risk products?
One.
Yes, they're all energy, and I don't know if Jan has it or not.
Thematic type of fund.
Wait, are these individual stocks or are they partnerships?
Funds?
They're not individual stocks. They are, now that I get on the radio, I forget.
Take your time. I want you to take your time because it's so important to us that you get this right. I cannot tell you how much we want you to get this right. And it's not to make any money for us.
I know. He does have me in gold.
Oh.
And then he has me in energy, and he has me in energy in my annuity.
Yeah, Martin, I don't know how to say this nicely, but
no, you can say it nicely.
Okay. You got to fire this guy. You got to
fire this guy. You all got to fire this guy. Yep. This guy is bad news. Yeah, he got lucky and made you some money because he guessed right.
And Gold, had a great year in 2024. Okay.
This guy is dangerous.
Right.
He is a bad money manager. He is absolutely not acting as a fiduciary to you. He is trying to make himself commissions because he sold you an annuity. I know that's the case in that one.
So he's
I don't
not
know
100%
these other products,
fiduciary.
but if these are gas partnerships, then he's making huge commissions off of you selling you those. This guy must be fired, Martin, must be fired. And again, we're not saying you should hire us, but honest to goodness, you should call Tom Just go to talkingrealmoney.com and make an appointment to meet an advisor.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
I want to finish the thought with Martin, by the way, because I do want to say thank you for, he remembers the fact that my father was a World War II veteran who flew B-24s. He was talking about his father-in-law. In Europe. And my
his dad was in the Pacific. Yeah.
Get ready to mark 20 years since he's been gone here in a couple weeks.
Skip bombing was actually, they learned, was a very effective way of, because they hit the water and they'd skim it like a rock right into the side of the ship because it was hard to hit them from above.
Yeah,
they had a narrower profile.
Yeah. So anyway, thank you, Martin, for remembering.
Martin. I just got up Martin.
You already did it. We already told him.
No, but this guy's, I could feel the rest of the listening public out there, people who've been listening for a while going, oh my gosh, Don and Tom are hating this.
Yeah.
We hate it because
it's not good advice.
It's not good advice. It's self-serving advice.
Yeah, exactly. Yeah, all those things. So,
and it's taking advantage of people, and I hate that so much.
Okay, this is it. This is the last call. I think I busted another prediction. I had predicted Retire Meet would be sold out at the end of this week, so I guess I could technically still say today because it's still the end of the week. But it will be sold out this weekend. And it's 3 weeks from today. I think we're just like 10 or 20 people short of what we can take. So if you would like to join us.
Aren't we running ads next week?
No, we are not running ads.
Good, because we better kill the ads.
Yeah. So yes. So if you'd like to see us, two of us, Paul Merriman, Joe Salsihai, Herb Weisbaum, etc., in person at the Maidenbauer Center on Saturday, February 8th for Retire Meet 11. This is the time to register. Literally right this minute. We'd love to see you. It's a great event. Got nothing but positive reviews.
If you're hearing the
years.
Podcast, you can still sign up for the virtual. Though,
that's true. Yeah, the virtual.
At retiremeet.com.
Yeah. But we'd love to see you.
Spelled the way you think it would be spelled.
This is not a meetup with other retire.
Well, no, it is a meet. It's not a place to get hung beef.
Okay. Or other. Yeah, okay, fair enough. So,
it's funny. Here's something I didn't know. I bet you didn't know this either. I started watching Shogun. Really well made. Speaking of hung meat, why? I'm still trying to figure out that the British guy, the Anjin, the pilot, who is in Japan, he hangs a bird, a dead bird that they hunted, outside his house to rot before he eats it. Did they do this in the old days?
I don't know.
It
doesn't sound
really
very
disgusting.
Appetizing.
It was really anyway. It's not that kind of meat. It's MEET.
Yeah, and it's a great day. Yeah, so join us.
And the other thing is, we want to help everybody we can help. And there are a variety of ways we do that. One of the ways is on the shows and podcasts. And you can ask us questions for those either by calling the show that we do on Saturdays on Northwest News Radio live at 855-935-TALK. And that's noon to 2 Pacific, 3 to 5 Eastern. Or you can send in questions or speak in questions at talkingrealmoney.com on the contact form. The other thing that we don't push very often, this is not a sales pitch show. I hate it when it turns out to sound like it is. But in Martin's case, I didn't know where to send him to get the help he desperately needs right now. So that's why I said, go to talkingrealmoney.com. There's a button that says Meet an Advisor. Now, let me tell you the deal. You can sit down, speak with one of our advisors, including Tom, for a while. We hope less than an hour. I give them an hour.
I give people an hour. Yeah.
And we promise you we're not going to pitch you on becoming a client. We just want to get you on the right track. Now, if you find you need us, great. We would love to have you. But we're not going to push you to do that. So go to talkingrealmoney.com and then click on Meet an Advisor and pick a time. We'll meet with you. Just go to talkingrealmoney.com.
We hope hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. To keep the lawyers happy.